You get a letter from your workers' comp carrier and it says they need to audit your payroll. And the first thought most business owners have is, what did I do wrong? The answer is probably nothing. But the letter still needs your attention because what happens next determines whether you owe more money, get money back, or find out your policy has been set up wrong since the day it was written. But the letter still needs your attention because what happens next determines whether you owe more money, get money back, or find out your policy has been set up wrong since the day it was written. If you don't know who I am, my name's Jim Eddington, and my agency helps individuals and businesses with their insurance every single day. We work with business owners through these audits regularly, and what I can tell you is the ones who understand how the audit works almost always come out in better shape than the ones who don't. Workers' comp premium is built on a formula. It's your payroll divided into blocks of $100 multiplied by a rate. That rate is set by the class code assigned to each employee based on what they actually do at work. A person answering phones in an office has a different rate than a person framing walls on a job site. The difference between those two rates can be massive. We're talking a few cents per $100 of payroll for office work versus several dollars per hundred for construction trades. Multiply that across a full year of payroll, and small differences in classification produce big differences in premium. When you buy a workers' comp policy, you give your carrier an estimate. You estimate how many employees you'll have, what you'll pay them, what kind of work they'll be doing. The carrier uses that estimate to set your premium for the year. But a year is a long time. New people get hired, people leave, roles change, overtime picks up, and by the end of the policy term, the estimate you gave at the start almost never matches what actually happened. That's what the audit's for. It's not a punishment, it's the carrier reconciling what you estimated with what you actually did. Here's where it can get real. You start the year with 50 employees, by summer, you're up to 65 because work picked up. You brought on a couple of admin staff and 13 new crew members across multiple trades, each one falling under a different class code. A project manager who used to work from the office started to go to job sites 3 days a week. You paid more overtime than you expected because you landed a big contract in the third quarter. None of that is unusual, but every one of those changes affects the premium. More payroll means more premium. 15 new employees spread across different class codes means the carrier has to reconcile each one against what you originally estimated. That project manager who moved from the office to the field may need to be reclassified into a higher rated code. Overtime has its own rules, and depending on the state, the carrier may calculate it differently than you'd expect. In most states, if your payroll records separate overtime properly, the carrier reduces overtime paid down to the straight time equivalent. So if someone earns $30 an hour and works overtime at 45, the carrier only counts 30 for those overtime hours. But there are exceptions. In the states we write, Nevada and Utah are two where overtime pay isn't reduced to straight time. The carrier calculates premium on the full overtime amount. Other states have their own rules on this, so it's something to verify with your agent. That catches a lot of business owners off guard, especially if you've got crews working 60-hour weeks. This next one's the single biggest audit problem we see, and it's the one that creates the largest surprise bills. Class codes are assigned based on what an employee actually does, not their job title. A project manager who's truly office only may qualify for a lower rated classification. A project manager who spends part of the week on construction sites may not. Those two outcomes can be separated by $10, $15, even $20 per hundred of payroll. Most of the time, misclassification isn't intentional. The business described the role one way at the start of the policy, the employee's duties shifted over the year, and nobody updated the carrier. The auditor shows up, reviews the job descriptions and the payroll, and reclassifies based on what actually happened. If the reclassification moves employees into a higher rated code, the premium adjustment can be substantial. And here's the part that makes it worse. If the auditor can't get clear documentation about what an employee actually does, the default is the highest rated code that applies. Not the lowest, not the average, the highest. That's why job descriptions and payroll records matter. They're your evidence. Without them, the auditor has to assume the worst. If you have employees who do a split between office work and field work, talk to your agent about whether that split can be documented and classified separately. Some states allow it, but the documentation has to be tight and it has to be maintained through the policy term, not reconstructed at audit time. Now for the second biggest audit surprise, and it hits contractors harder than anyone. When you hire a subcontractor, the auditor is going to ask for a certificate of insurance proving that the sub had their own workers' comp coverage during the time they worked for you. If you can't produce that certificate, or if the certificate was expired, or if it doesn't cover the dates the sub was on your job, the carrier picks up that subcontractor's pay as if it were your payroll, and they classify it under whatever code applies to the work that was done. So if you paid a subcontractor $40,000 for roofing work and you don't have a valid certificate showing they carried their own workers' comp, that $40,000 gets added to your payroll at the roofing rate. That's one of the most expensive class codes in the system. The audit bill from that one subcontractor alone can run into thousands of dollars. The fix is straightforward, but it has to happen before the work starts and not at audit time. Get a certificate of insurance from every subcontractor before they set foot on your job. Make sure the certificate shows active workers' comp coverage, not just general liability. For this audit issue, the question is whether they had workers' comp. Make sure the dates on the certificate cover the dates the sub is working for you. And keep those certificates organized because the auditor is going to ask for every single one. We covered certificates of insurance in another video on the channel. If you work with subcontractors regularly, that one's worth watching. There's another number that affects your workers' comp premium, and most business owners don't hear about it until it's already working against them. It's called the Experience Modification Rate, or your MOD. Think of it like a credit score for your workplace safety record. A MOD of 1.0 means your claims history is average for your industry and size. Below 1.0 means you're doing better than average. Above 1.0 means you've had more claims than expected and you're paying a surcharge on every dollar of premium because of it. Your MOD is calculated using about 3 years of claims data, not counting the most recent policy year. And here's what makes it powerful. It multiplies everything. If your base premium is $10,000 and your MOD is 1.2, you're paying $12,000. If your MOD is 0.5, you're paying $8,500. Same payroll, same class codes, 15% swing in premium just based on your claims history. That's why claim frequency matters, even when the individual claims aren't huge. Frequency hurts your MOD more than severity in a lot of cases. 3 small claims can do more damage than 1 large one. And once a claim is on your MOD, it takes years to roll off. If you've had a rough stretch, you're paying for it long after the injury's healed. The audit letter gives you a window. Use it. Pull your payroll records for the full policy term. Break them out by employee and by class code if you can. Separate overtime hours from regular hours, especially if you're in a state where the overtime reduction applies. Gather every subcontractor certificate of insurance. Make sure each one shows active coverage for the dates the sub worked for you. Review your employee roster. If someone's job duties change during the year, document that now with dates and descriptions. If you hired temporary workers through a staffing agency, pull those invoices because staffing agencies generally carry their own workers' comp for the people they place. That payroll shouldn't be on your audit. And talk to your agent before the auditor shows up. A good agent can review your records ahead of time, flag anything that looks off, and make sure you're not walking into a surprise. That's part of what we do. We'd rather catch a classification issue before the audit than argue about it later. During the audit, stay organized and answer the auditor's questions directly. Provide what they ask for. That's not about hiding anything, it's about making sure the auditor gets clear, relevant records. When the audit's done, ask for a copy of the worksheet. Review it line by line. Check the payroll numbers against your records and check the class codes against your actual job descriptions. Check the subcontractor section and make sure nothing was picked up that shouldn't have been. And check your experience mod to make sure the correct one was applied. Auditors make mistakes. It's not common, but it happens. If something doesn't look right, you have the right to dispute it. Most carriers give you 30 to 60 days from the audit statement to file a written dispute. Your agent can help you put that together. If you don't dispute it within the window, the numbers stand and you owe whatever the audit says you owe. And if the audit results in additional premium, ask your agent whether there's a payment plan option. A large audit bill that hits all at once can strain cash flow. Some carriers will work with you on that. A workers' comp audit isn't something to dread. It's something to prepare for. The business owners who keep clean payroll records, collect subcontractor certificates as they go, and review their class codes with their agent before the audit are the ones who come out ahead. The ones who throw a box of receipts at the auditor and hope for the best are the ones who get the surprise bill. If you've got a workers' comp policy and you haven't talked to your agent about how the audit works, now is a good time. If you don't have an agent or you're not sure your policy is set up the way it should be, we can help with that. You can get a quote from the link below. We also put together a free audit prep checklist and document organizer so you can get your records together before the auditor shows up. That's in the description too. Subscribe to the channel. We publish most business days, and what we cover is for individuals, families, and business owners who want to understand their insurance before they need it, not after. Thanks for watching.